Welcome to Financial Date Night. Okay, tonight we are talking about syndications and funds. Before we start, do you have any questions? Are you recording me with your meta classes? Gosh. Do you have any questions
I
before we
do
start?
not have any questions.
Okay, this is part 1 of 2, just so you know. Because this is a big topic and it's kind of hard to cover in one session. Okay? So
Could you introduce yourself really quickly?
You already know who I am.
Yeah, but they don't know who you are.
Ashley Edwards.
Can you look at me while you do it?
What kind of production are you making?
I'm just trying to make sure that we're capturing all this dope information.
My name is Ashley Edwards. Thank you for being here today. We're going to be discussing syndications and funds, just the foundational aspects of them, okay? We're going to talk about what they are, the difference between the two, which one does what, who does what within them, and how you make money. But we'll also talk about what can go wrong, of course. As an attorney, that's like the first thing I think about, so can't ignore that. There may be technical difficulties. Just ignore it and roll with it, okay? That's just life, all right? And if you have any questions, feel free to stop me. Okay, big picture. So what are we even talking about, all right? So a syndication or a fund allows investors, a group of investors, to pool their money and resources together to buy or lend on a deal that is too big maybe for one investor to do alone, right? And it also may be too complex. So it may be that the size is fine, but the complexity is too much for them. Mm-hmm. Now, as a solo investor, you find the deal, you fund the deal, you manage it, you're the operator, right? You're the funder, you're the operator, you're doing the whole thing yourself. And your capital is as far as you can go, what you have, unless you're leveraging someone else's capital, right? With a syndication, you can do that same thing, but one specific, much larger deal, but you're using the combined funds of a group of investors, and it's run by a deal sponsor, right? So in this situation, the group shares in the upside and the risk, whereas with a solo investor, the single investor, so like just you and your real estate property, that's all on you, right? You take the risk, but you also don't have to share in the upside, okay? With a fund, this involves multiple deals inside of one vehicle. Now, when I say vehicle, that can mean like an entity, so like an LLC or corporation or partnership. Investors commit their capital upfront, and the fund manager deploys that capital over time, right? So with a fund, you're talking about multiple deals, multiple transactions, whereas with a syndication, you're talking about a takedown of one large deal, and then usually there's an exit with a syndication, whereas a fund is ongoing. Any questions so far?
No, I think I understand the difference. I mainly was wondering the difference between a fund and a syndication.
Okay.
Makes sense now.
So an analogy to help you remember is a syndication is a group trip to one destination, whereas a fund is a travel agency that books many trips. Okay? You know, gotta travel.
Yes.
All right. Now, understanding the structural differences is super important before you decide to invest in either of them. Okay? So this is a chart, and I'll just point out some of the key differences here. So there's definitely some similarities. So in terms of the investor role, you can see that they both have limited partner investor roles available, which is the more passive form of investing. So not the person operating it, but just the person putting their capital in, right? They both have that feature. Another thing to point out that is the same is you committing your capital, right? So it's going to be committing your capital for a certain amount of time in either one, okay? But there's a lot of differences here. So we talked about the travel agency example. So in syndication, that's a one-time deal structure. Now that one deal may go on for a long time, right? In a syndication, you can have your money in, and the goal could be to, let's say, acquire this hotel, to refurbish it, to make it profitable, operational. That could take 3 to 7 years, you know, just depends on the project. So it's not that it's necessarily faster than a fund. That could be even longer. Whereas with a fund, it's an ongoing thing, right? It's not necessarily that you are putting your money into a specific project. Rather, you're putting your money into a pool of funds that are used for various things.
Gotcha.
Now, there are funds that are structured where you are putting your money into a single project, and I actually just saw an investor who just launched a fund post about it recently. So the way his fund is structured is he uses the fund proceeds to buy real estate and rehab the properties and then make them operational. But in his instance, when you join as an investor, you can allocate your money to a specific project and be the first lien holder on that project. That is very unique. I've not seen that in a lot of funds because most of the time it's the fund who holds the security, right? But in his fund, you can actually back up your specific capital in the fund by being a lien holder on the property.
So then if this is multiple people joining this, so there would be multiple lien holders, how do they decide who is first? Is it like literally first come, first serve, or is it highest amount?
Yeah, it's first come, first serve, but also highest amount. So like, let's say in that fund, he plans to acquire 30 properties over the next 3 years, or something like that. And he has one that he wants to get for 100,000, and then it's gonna take 50,000 to rehab. And you're like, oh, I have 100,000 I wanna deploy. And he's like, well, can you also cover the 50? And then you can be the only lien holder. And you're like, no, I can only cover the 100. So you come, you give your 100, you're first lien holder on that property in that fund. Now, someone else comes along and they say, well, I only have the 50,000, I could do the rehab for this property. I'm happy being second lien holder. And he says, great, I'll take your funds for the rehab part.
Okay, but that's a very unique situation. Most times, being in a syndication or a fund, you get no rights to being a lien holder at all.
Correct, to my knowledge, and I'm very new to this space.
Yeah.
But from what I've seen, that has been the thing that has made me shy away from funds and syndications, actually. The lack of a security instrument, right? I mean, some funds have offered a personal guarantee, which does nothing if they have no assets. But this fund is saying, no, you can be the lien holder on this property if you bring the funds for that property, which is really cool. And I think a fund has flexibility in that way. Yeah. So another big difference is that with a syndication, you are choosing that deal that they presented to you. So if you join a syndication to take down and refurbish this hotel, you know that that's what the project is about, right? Whereas with a fund, typically you're not involved in the choosing of it, okay? As a passive investor, you're typically just putting your money in, expecting a certain level of return, but you have an idea of how the fund is investing.
And you explain that idea to the individual. So a fund is basically, I think we had talked about this too. A fund, once explained, it's like a mutual fund outside of the stock market. Like if there is a certain theme with the fund, there's a certain theme that goes with the fund. So no one's just like investing in a fund. It's like, this is a fund where the investment is royalties. This is a fund where the investment is real estate or.
Yeah. Okay. So the fund can do multiple things, but typically it does one thing or a few things really well.
Gotcha.
Yeah.
Okay.
And I have a real life example that we're gonna go over too. So, yes, syndication, specific deal, fund, diverse deals, both involve raising capital, and the way that you get your money out is different as well. So typically with a syndication, you can't really get your money back until the deal is exited, right? Until they sell the hotel, for instance. Whereas with a fund, there's usually some sort of provision that allows you to pull your money out. All right, now there's two main roles in both of these structures, the general partner and the limited partner. So you may see these acronyms thrown around, GP and LP. Now the general partner is usually the operator of the fund, the person that is in charge, or person or people, it could be a group of people, in charge of finding the deal. They are building the pot of money. You know, they're running day-to-day operations or hiring someone to do that. They're literally the decision makers with this pool of money. They typically are ones who end up signing any debts and being personally responsible for those debts. They also sometimes put in little to no capital. Instead, they're raising capital. But there's also situations where they put in more capital, right? Depending on how much they can raise. They get paid in multiple ways. So if you're a GP, you're most likely getting paid 2 or more ways from this fund. You may be getting paid and fees that you charge for your management, you may also be getting paid in profit share. You may also be getting paid for finding the deal. Like there can be different layers to it. But as a general partner, you have high upside and high responsibility. And that's just a general legal principle, right? So people always ask about entity types like LLCs, corporations, but they fail to realize that a general partnership is also a legal structure, actually. So a general partnership is the default legal structure for two or more people doing business together. Now, if they never form an entity, the law will treat them as a general partnership. Unless they do something specific to form a limited partnership or a limited liability partnership, which is referred to as an LLP, then they're going to be treated as a general partnership. And that's why a lot of lawyers will say like, ooh, we don't like to use partner language. Like even in contracts, we don't like to say the two people are partnering because we don't want to create confusion and say like, yes, we're personally taking on liability for the activities of the business.
Gotcha.
Yeah.
And with general partners, you can choose the amount of percentage each person has when you are creating the entity or when you're talking through
Correct.
like taxes and things like that. Okay.
Yep.
Gotcha.
Mm-hmm. Now, a limited partner is usually the passive investor in a fund or a syndication. They provide capital, they don't make no decisions, no day-to-day work. They also don't have the power to make decisions. So even if they wanted to, they couldn't make decisions. Their liability is limited to what they invested, right? So they have no personal liability. If they put in $15,000, they can only lose $15,000. Even if someone slips and falls and dies, or something goes wrong, the max they can lose is the money that they put in. And they have lower upside, but also lower risk, right? And so when it comes to a syndication or a fund, depending on your role, that's going to determine like how responsible you are for things, but it also will determine how much money you can make.
Yeah.
So that's why the people that we've heard about recently who are coming under fire for mismanaging fund proceeds or for losing people's money, like those are general partners being blamed for those things. Yeah. And if they do something wrong, like let's say they run afoul of the SEC rules or they, fall into some liability because of how they operated the fund, they can be personally liable, right? Their personal assets can be at risk. And so that's why there's a huge level of responsibility associated with being the general partner of a fund as opposed to a limited partner.
Gotcha.
So as an analogy, my private money lending today is similar to being a limited partner in a project, right?
Gotcha.
I bring the capital, I'm not doing none of the other stuff. Like it's a fix and flip, I'm not finding the deal, I'm not hiring the contractors. I'm literally just being like, all right, great, here's the money, lien position, security deed, blah, blah, blah. Let me know when you're done.
Mm-hmm. So you get a lien position when you are a limited partner
When I'm private lending.
When you're private lending.
That's the difference between private money lending and being in a fund usually.
Gotcha.
But the one I just told you about, I don't know how his fund is structured, but he's offering lien positions. And I think it's because you're playing a double role. Like I don't know the legalities of it, but to me, there may be a conflict, right? You're saying you're a limited partner in this fund, but you're actually just a lien holder, right? So I don't know how they're setting that up, but it may be they're layering different benefits, or just doing an advanced deal structure. Yeah. All right, so how does a GP get paid since they're taking on so much risk? So some different ways they can get paid are the acquisition fee. Some GPs will charge 1 to 3% of the purchase price just to find a property and get it closed on, right? This could be in a syndication or a fund. And I actually met someone who, this is one of the fees she charges in her fund. So this is what she does full time, so she gets paid to do this, and she has to have multiple ways of getting money. It can't be that at the end of 7 years, she gets a payout, right? So every time she finds a deal, and her fund only focuses on acquiring land and providing loans to the real estate investor so they can develop the land and then make money off of it or sell it. So another way they can get paid is the asset management fee. So it could be 1 to 2% or more of the assets under management, and that's paid annually, just for managing what the fund owns, right? So that's another way they can get paid. A third way is they can get their carried interest. So there's different terms, and we'll go over some of the terms, but they can make 20 to 30% of the profits just above the hurdle rate, right? And that could be a huge payday if the fund or syndication performs well.
Yeah, hurdle rate, we're gonna talk about later.
Yep.
Okay.
And then they can get a disposition fee. So in a syndication, for instance, once the asset sells, they may get paid on the back end too. 1 to 2% of the sales price, separate from their profit share, just for the matter of they were able to successfully sell it, they can get paid in that way too. Now, the thing with GPs is even if the deal underperforms, they will get paid. Okay.
If they have this structure set up to where they make sure that they get paid.
Correct.
Okay.
Yeah, which if they're a smart fund manager, they would.
Yeah.
Okay, we'll go into some of the other things. Now, how does the LP get paid? Now, the returns can flow to the limited partner in several layers, and those are collectively called the waterfall. Now, the first way is through cash flow distributions. So some funds or syndications pay out quarterly, usually a fund, not usually a syndication. They'll pay out quarterly or annual investments during the whole period. On average, you're looking at 4 to 10% annually, but some funds perform better than others. They can get a preferred return. So this is something that they would negotiate. This is not something that's necessarily offered. It's something that is above and beyond what was promised. Amber Alert. Okay, cool. So another way is with the equity upside or profit split. Now this is also something you would negotiate, okay? So after the preferred return, the remaining profits are split between the GP and the LP, usually 70-30 or 80-20 in favor of the LP, if there's profit to split. And then return of your capital at exit. So when the asset sells in a syndication, the LPs get their original investment back before the profit sharing begins. Now, we talked a little bit about funds or syndications where money was mismanaged. In those instances, the people did not get their money back. But that is a risk that you take when you put your money in someone else's control. Mm-hmm. And there's extensive paperwork outlining this when you do something like invest in a fund. However, people don't like to read, so.
But with those situations of the mismanagement of funds, that's different, right? Like your funds being lost to mismanagement, and are you able to then take legal action even though the paperwork says your money is at risk of being lost?
Yeah. So
not that the deal went sour, it's just that the fund manager or the GP handled it poorly, and that's why no one got paid.
Yeah, that's if you can prove that they did something illegal. Yeah. So there's this one guy, I'm not gonna say his name, but he was under fire he was accused of taking fund proceeds and using it for his personal benefit. People accused him of buying his primary residence with the funds, with hiring family members who weren't really doing anything, with allocating money to things that the fund never said it was going to invest in, things like that. And it was a lot of money that was lost. A lot of famous people lost money in this fund, and a lot of regular everyday people like me and you lost money in this fund. But they trusted him, right? So that's why they invested with him. So types of returns in realistic ranges. So there's a lot of different phrases and vocabulary that gets thrown around in here, and we'll get into some of it, but some of it doesn't matter as much. So cash on cash return, this is basically the annual cash flow from the syndication or fund divided by the amount of cash that was invested in the deal. So on the low end, this can return 4 to 6%. On the high end, 10 to 15, but it could even be higher. A lot of times the best deals are the ones that we don't see unless we have a connection with someone that gives us access to those. And those are the ones where you're going to see the above average yields.
Not the ones that we're going to be able to Google.
Correct. You can probably Google it, but you still won't be able to get access.
Gotcha.
Yeah. So that's the cash on cash return is what you actually get every year in your pocket.
Do you have to be like an accredited investor or something?
Yeah, we'll talk about that. Some of them you do. Yeah. That's more of that is going to be in part 2, but yeah. So depending on how the fund or syndication is structured, you need to be accredited. Internalized or internal rate of return, annualized return over the full hold period. So that's basically saying like over the entire amount of time that we held it, what did we make per year? So on the low end, 8 to 12%. On the high end, that could be 18 to 25% or more. And this is the total return blended over time. So this is the number that a lot of the sponsors of the deal like to advertise to bring people in. They're like, look, it's a IRR 25%, like, but you're like, wait, but that's over how long though? You know, like what are we talking about? And then you have the equity multiple. So this is the total amount of dollars returned divided by the total amount you invested, right? So like, how much did my money grow is really what that's asking. So on the low end, 1.5 to 1.8 times what you put in. And on the high end, it could be 2-3 times or plus, right? So if you put in 100,000 and you get back 200,000, that's a 2x multiple. Now, these are just some estimates for different types of deals for these numbers. So like multifamily real estate, you're probably gonna get 5 to 8% cash on cash return, 12 to 18% IRR, 1.6 to 2.2 equity multiple. And then you can see the different types of ones. So like with a value add development, this is where you are buying low and a distressed property or something, and then you are adding, forcing equity into it, and then disposing of it. Of course, that's gonna have the biggest return. For debt funds, these numbers are lower than what I've been hearing, but again, I don't know because I've never actually done it, but I would imagine it could be a lot higher than that. And then commercial real estate has its own numbers, which are not bad, right? Like a 2 times multiple is great, but I know you be doing that on the daily with your other stuff.
What's the difference? So debt and private lending funds, right?
So it could be, yeah, it just depends, like, because there's different types of debt, right? There's credit lines, there's notes, which is different from private money lending. Like there's underperforming notes and performing notes. Those are all debt. So you can say debt fund, but it's like, what kind of debt are we talking about? And who's the debt with, you know? So what can go wrong with these types of things? For the GP, a lot of times they're giving personal guarantees. Now, if the deal defaults, their personal assets are on the line, assuming they have personal assets. There's also deal execution risk. So cost overruns, vacancies, a bad market. This means the GP will earn nothing and probably face a lot of lawsuits. Regulatory and legal risks. So securities laws. So when I mentioned the SEC, those laws require proper filings, proper advertisings. And if you get it wrong, that could be fines or worse. You could be banned from ever doing something like this again. You can lose your licenses in certain things. And then there's reputation risk. This is huge. This is what I'm seeing a lot of happening right now. So a bad deal, especially if people feel like it was in bad faith, can really end your ability to raise capital in the future.
Because nobody trusts you.
Correct. And arguably, should they? I don't know. LP risks. Okay, so as a limited partner, your money could be locked up for the deal's lifespan, right? So depending on how the fund is structured, you may not be able to take your money out for a certain amount of time. And this is what I first understood about syndications and funds. That was a complete turn off for me. I was like, that sounds like a CD. Why would I want my money to be locked up in this thing that I have no access to, no control over for this long period of time, right? And I think part of it is I couldn't even think of a person I would trust to give my money to like that, right? But the more people I meet, so I'm like, oh, okay, yeah. Sponsor risk. So if the GP is bad or they're dishonest or inexperienced, then your returns suffer, right? Or you don't get nothing back, okay? So you're really betting on the operator of the fund or syndication as much as the deal itself. Market risk. So rates can rise, rents can drop, values can fall, all kinds of things that can happen, and what they promise you may not necessarily pan out. And then just total loss. So this is not super common. There's tons of funds. It's not really common, but it's a real risk, and the fact that your liability is limited doesn't necessarily mean your money is safe and that is guaranteed. Yeah. All right. Some of these terms, I know. I'm not expecting you to remember these, but we're gonna review them and we'll bring them back and you'll see them in context. So PPM, this is a private placement memorandum, but you'll always hear people refer to it as a PPM in the industry. It's literally the contract. It's the document that says you're making a risky investment, you could lose all your money, you don't got no rights to make no decisions. Like, that is the document that outlines that entire thing, and it's a long document and it should be read, but my hunch is most people don't read it. This is also the document that I would have counsel read for me, right, and negotiate on my behalf. Like some of those deal kickers and add-ons and stuff, this is where that would happen in that document.
So that document not only explains the legality, but it also explains the deal itself, like
Yep.
where the money's going, how much it costs.
Yep.
Okay.
Mm-hmm.
The risks and things like that. Well,
Yep.
with the risks going here too?
It will say you can risk losing all your money.
Okay.
Yeah. Mm-hmm. Operating agreement. This is the contract that governs the actual entity structure of the deal. I mean, not the deal, the syndication or the fund. So the fund may be like an LLC, for instance, and it will have its own operating agreement outlining how profits are split and what GPs can do and can't do and what LPs can and can't do. You're familiar with an operating agreement, I'm sure. Hurdle rate, you asked about this earlier. This is the minimum return that the limited partners have to receive before the GPs get their promote, right? So
it's like what is it called in healthcare?
deductible.
Right? I mean, not
kinda,
really, but
yeah.
you gotta pay the deductible before you can start reaping the benefits.
Yeah, sort of. Yeah, it is like a deductible. So this is the minimum amount that the limited partners have to be paid out before the general partners can get their profit share above that rate. Okay.
So they can still get paid within that rate.
Yeah.
General partners can get. Is this annually or just overall?
No, I think this is overall. So
Okay.
this is before they can share in the profits. Yeah. So they can't start splitting up profits before they've paid out the LPs. Yeah. Then you have the waterfall. So this is the order of who gets paid and when, which definitely looks like a waterfall.
Yeah.
The promote is the GP's profit share above the hurdle. So the hurdle is the minimum the LPs can get. It's also called the carry or the carry interest. So those three words are used interchangeably.
Okay.
The hold period, self-explanatory. That's how long the investment is expected to last before any assets are sold or refinanced. That mostly applies with a syndication more than with a fund. Capital call is when the fund asks the limited partners to send their committed capital, and it's often done in deal stages. So I actually realized that I have invested in a fund. Yeah, because I had a capital call once. I didn't realize I was investing in a fund. This was like 6-7 years ago. And yeah, it's basically like after you've already committed and now they're asking you to bring your money to the table. Distribution, the cash paid out to investors from income during the hold or profits at exit.
Makes sense.
And then accredited investor, you brought this up earlier. So this is a person who meets the SEC income threshold or the net worth threshold. And as of late, the income threshold for an individual is $200,000 for the past 2 years. And the net worth requirement is $1 million, not counting their primary residence. And most syndications require you to be an accredited investor. For a couple, the income threshold is $300,000 for the past 2 years. So net asset value is the per share value of the fund's assets minus its liabilities. And it's how your investment is priced in a fund. And then you have the interval fund. This is a registered fund that offers limited liquidity windows, so like quarterly repurchases or pulling your cash out, rather than daily trading like stock. Okay, you don't need to memorize this.
Okay, but I got you though.
Are we accredited? So can we invest in these types of investments? Yes. So as we discussed, most private syndications and funds require investors to be accredited. Not all of them, but a lot of them do. And the 3 ways to qualify that we talked about: the income test, the net worth test, and then there's also a professional test. Yeah. So if you have a Series 7, Series 65, or 82 license, or you're a knowledgeable employee of a fund, then you can also become accredited that way. Now, for us, we're accredited as a couple and as individuals. So if you want to invest in a fund, know that it's available to you. Okay, the capital stack. We're almost there.
Is this the waterfall? No.
No. So every deal has a capital stack, which is a hierarchy of who gets paid back first if things go wrong.
Oh, okay.
Yeah. So the lower you are in the stack, the safer your money is, okay? The higher you are in the stack, you have a more potential for return, but you also have a greater risk of losing your money. All right, so at the top, you have the GPs and the sponsors, as we discussed, right? They have the highest risk, but they also have the highest potential return. Okay?
So the people at the bottom get paid first.
Correct.
And the people at the top get paid last.
Unless there's some fraud, right? So the the argument is these GPs been stealing our money, they've been using it to enrich themselves, they've been buying houses, whatever. Like in that case, they basically violated the rules and stole the money
So the LPs
and claimed
first.
it was lost.
Yeah.
And then didn't pay the LPs.
Okay.
Yeah.
And the LPs would get paid before the senior and mezzanine debt in that case?
No. The debt will need to be paid first. But if in a fraudulent situation, things aren't going to go the way they should go. So what could happen is the GPs could steal the money, claim the market went bad, and file bankruptcy.
And avoid that.
Yeah. So the debt is always going to get paid first. So that's banks, private lenders, whoever has a legal right to get their money back. That's based on some sort of security instrument, right? Usually in real estate, it's a lien on the property that is recorded with the county recorder's office. Not just a promissory note, it's a lien on the property.
So the note at the bottom says running a debt fund means you are the senior debt layers, but the GP runs the debt fund, right?
So if you're running a debt fund, you are loaning out money. Usually you're the first lien position.
Oh, the GP is the one who finds the money.
Yeah, they're finding the deals and stuff.
But they're not
But the
one
fund,
funding the deal.
right, your money is being used to fund the debt, right? So you are the senior debt layer.
I see.
Yeah.
I think the word running was going there, but I get you.
Yeah.
You're funding the debt. I mean, you're funding the fund.
Yeah, we are funding the fund,
Yeah.
but the fund is giving loans. So they're going to be first lien position typically.
Gotcha.
Yeah.
All right, makes sense.
So lowest risk, because the senior debt position, so being the first lien holder means that if something goes wrong, if this property is, I don't know, abandoned or sold or whatever, that is the first entity or person to be paid. And if there's anything left, everyone else will be paid. And if there's not, oh well.
Yeah.
So then you have the mezzanine debt layer, which is like the lower lenders, right? The people with lower lien positions. So remember that one deal I was talking about where I was like, I thought I was going to be second lien position, but I'm fourth.
Yeah.
And I was like, that's not ideal. But then the amount of the debt is what made me like, $500, like that's not going to do anything.
Yeah.
Then you have preferred equity. So you have the LP investors. They have higher priority than the GPs, and they're at the top.
Okay.
So it's really from this way up.
Yeah.
Yeah. So this is where you ideally want to be. You see, private lender. Yes.
Yeah.
And then the
What
other
would a
one.
subordinate lender be? Just like someone who's not the, right? It's just other people lending that aren't limited investors?
It could still be lenders, like private lenders. It's just they don't have the first lien position.
Oh, I see.
Yeah, they
Okay.
are just a subordinate debt.
Yeah.
Yeah. So yes, as a private money lender, I'm usually at the senior debt layer or even the subordinate, the mezzanine
Like
debt
when
layer.
you were fourth.
Correct.
You were in the mezzanine debt.
That's my first time being.
Yeah.
Yes.
Okay.
So, but typically I'm like second lien, first lien,
Yeah.
which first lien is the safest position.
Mm-hmm.
But yes, you're right. Running a debt fund means you're the senior debt layer and you're pulling other people's capital to do it at scale. So in a debt fund, I lend my money, but in a debt fund, I can get a bunch of people's money and give out much bigger loans to different people.
Yes.
So do what I'm doing on a bigger scale. Now, real world example. Okay, structure by stepstone. Okay, so I'm gonna explain to you a real life fund that I am about to make an investment in. Okay. Now, Stepstone Private Infrastructure Fund, this is the actual name of the fund. It's a registered evergreen interval fund that invests in private infrastructure assets globally. So now funds don't only invest in real estate. They can invest in a lot of things. I'm sure you know that because mutual funds, hedge funds, etc. So this is an infrastructure fund. So roads, data centers, energy grids, airports, fiber optic networks, these types of things. Now, this is not a real estate or a debt fund. The underlying assets are infrastructure, not apartment buildings or loans. but it's also an equity fund, right? So the investors own a share of the assets, not a loan against the assets. Okay, so there's a lot of different ways these funds and syndications can be structured, but this is structured as private equity. So this is an example that we're using here because it's literally real life, but also the fund mechanics are very similar to some of the things we talked about. So my investment will be $15,000 and I'll be investing in Class S shares. So there's different classes of shares and that class will tell you what the rules are based on that class. Like how often you can get paid, when you can take your money out, how much you get paid, etc. The fund assets under management are 1.3 billion. The net asset value per share is $15.40 as of April 2026.
Per share. So would this be a mutual fund? Because we're talking shares, like actual ownership in
A company.
in a business or in a company. So
Yeah.
this would be the closest to like what a mutual fund
Yep.
is.
This is a private equity fund. So yes, yeah.
Okay.
The annualized return since their inception in 2023 has been 18.13%, and their year-to-date return has been 6.32%. Now, what makes this structure unusual is they have no capital calls. So you invest upfront at the net asset value. You don't do it in stages. You have daily payouts, and you have quarterly liquidity windows. So you can take out a certain percent of your shares on a quarterly basis. You get 1099 tax reporting instead of K1, which can make your taxes simpler. And it's registered under the Investment Company Act of 1940. I don't know what that means, but I'm gonna have to learn.
So you get a 1099 because that's just that's the tax form that you get when you are investing in a mutual fund, or is that that's the tax form you get when you're an employee, right?
And a contractor.
A contractor.
There's different ones. There's like a contractor one, miscellaneous.
Yeah. Okay. So then the daily subscriptions, is that you're able to add money, or like you said, receive money? You can get money every day.
Yeah, but I can also have my money automatically reinvested. So
Okay,
whatever
that's
money
what
I'm earning,
Yeah.
I can set it up to be automatically reinvested.
Okay. And it's called structure.
It's called Stepstone Private Infrastructure Fund.
Okay. Where would I find this? Like, if I wanted to invest in it, would I
Through your advisor.
my advisor
You can only invest through a wealth manager
in this particular
fund. So what happens is whoever you're working with to manage your money or whatever gives you options of different funds based on your goals. And with this one specifically, they have to set it all up for you. They have to open the account, they have to make the contact, they have to then help you facilitate the transfer. And they also get paid a small percentage of the commitment fee. So there's a small 1.6% commitment fee, and they get paid a portion of that.
Okay.
One time. So how this maps out to what we just learned. So GP, fund manager, runs the fund, makes the decisions, just like in Stepstone. LP, passive capital provider, that's gonna be me, and a bunch of other people or companies who've invested in the fund.
Yeah.
So completely passive,
Right.
no lien position,
Yeah.
no protection, just out here raw dogging it. Management fee. Management fee 1 to 2% of assets under management annually, but it's 1.6 on their net assets under value. Their net asset value. Distributions are paid to LPs from the income. It says that they're paid annually, but they're actually paid on a regular basis. They're paid monthly, I believe, but they are accrued daily.
Paid to LPs from income. Oh, this is specific to a fund. Not
This fund that we just talked about.
Oh, okay, gotcha.
Yeah.
All right.
Tax reporting is usually K1, but this is 1099.
The
And
liquidity though, you can pull it out. You said every 3 months,
every quarter,
and you can only pull out 5%.
5%, depending on what class you're in. Different classes have the ability to pull out different amounts.
your class, you can't pull all of it out.
Nope.
It'll take a long time to pull
Yep.
everything.
But I can make a request, and if there's no other people that would make that go over, I could pull out more that quarter, because there's a cap on how much. So 5% of the fund can be withdrawn quarterly. If what I'm requesting doesn't matter and they can meet all the other requests, then we're good. I can take out all my money in that quarter.
5% of the overall fund?
Yeah.
So collectively, you all can only pull out 5%?
Yes, quarterly.
So if you wanted to pull out 5%, but someone wanted to pull out 1%, you can't. You have to only pull out 4%.
If I want to pull out 100%, but it will cause the fund to go over the total 5%, I can't pull it out.
I see, because you do not have 100%. Okay.
Yeah, I don't.
Even you pulling out 100% probably
It's
would
not
be
gonna
5%.
do anything.
Gotcha.
It's a $1.3 billion fund.
Yes.
If I want to take my whole money out in a quarter, it's probably gonna be fine.
I see.
Yeah.
Okay.
And that was a requirement that I had. So when I went to my advisor saying, look, I'm interested in a private equity fund, but these are my stipulations. I need to be able to get my money fast as possible. I would like to be paid as often as possible. I don't want no 1 year or 7 years. Like, I don't play those games. I want to be able to be like, all right, I know in a few months I can take all this money out, right? And I also want something that can compound and that's making over 10% a year, right? So this is what was presented to me. Minimum investment, usually $25,000 to $100,000. There was another fund I was considering last year, an oil and gas fund. The minimum investment was $50,000. And for that one, you get paid quarterly, but I don't remember the other mechanics. And that one had tax benefits though. This one does not. Yeah. For Class S, the minimum is $5,000, I guess. So compared to a typical unregistered private fund, these definitely have some higher benefits. So a little bit higher on the payout. More flexibility with when you can take your money out. And this is just an example of like what a real fund operates like.
You're in this fund.
I'm about to be in this fund.
Oh.
Yeah, I've already started paperwork. All right, so stocks versus this world, because I know you like the stocks and the futures and all that stuff, right? So if you're coming from a public market, this is how private markets compare to where you're coming from. So in terms of liquidity, in the public markets, you can sell at any time, right? Or usually, whenever the market's open, or they allow you to sell. Whereas in private markets, you're usually locked up for years or limited windows depending on how the fund is structured, right? So like for me, I won't be able to pull out unless it's once a quarter. In terms of transparency, public funds or markets, they have public filings, daily prices, right? Whereas in a private market, only the people in it are gonna have access to those documents. Minimum investment, $1 or even a fraction of $1. Whereas in a private fund, it's usually, $5K is low. I'm typically saying $25K and up. Yeah. And some funds that I'm not even privy to, I'm sure have $1 million minimums, I'm sure. And then the return. So if you're investing for the long term, not day trading, you're looking at 7 to 10%, maybe 12% on average. In a private fund, you're looking at 12 to 20% plus. Volatility, daily in the public market, it's always moving. But in private fund, there's not really an emotional noise going on. These are people managing this on the hush. So there's not a lot of movement, and also there's not daily pricing of the fund. The fund isn't being evaluated on a daily basis by the public. Right? Who manages it? Company executives manage in the public market, right? Whoever's in charge of that company. Whereas in a private fund, it's the GP or the fund manager, and you vet them yourself. Your role in a public market is a passive shareholder, but similar in a private fund, you're a passive limited partner. So same concept, but different rights. And then tax treatment in the public markets, you're looking at capital gains, but also you're looking at dividends. And then in the private funds, you can depreciate the value of your shares, right? You may get a K1 or a 1099 depending on the fund.
You depreciate like you would do with a home?
Because you have equity, right? Just like you can depreciate the value in your company or your company's equipment and things like that.
Oh, I see.
So futures is actually closer to private fund investing than like stock trading, right? So it's asymmetric risk, reward, and leverage, and that is really what's happening here as a limited partner investor.
Oh, I see. I was like, but I got you.
All right, so in part 2, we're gonna review the language again, but we're also gonna go deeper into what I'm thinking about doing, which is a debt fund, right? This is something I've been thinking about. This is something people have proposed to me. And I'm like, okay, I gotta educate myself before I agree to be in charge of other people's money. Okay. So what a debt fund is something we'll talk about. The natural on ramp, so like why private lending is a natural transition into a debt fund. How debt fund managers get paid, so the fee structures, the carried interest, what the economics look like, what it takes to launch a debt fund. I've been researching this, very interesting. The realistic timeline, which probably is 3 to 5 years out, but depends on your resources and who you're working with. And then the questions that we should be asking, right? Target borrowers, fund thesis, track record, future limited partners, and what to do differently between now and the launch of the fund.
Do you know where you plan to launch? Excuse me.
I don't even know if I plan to launch.
Oh, okay.
Yeah, it's all exploratory at this point.
Yeah.
But I do feel a little bit of pressure to learn faster because the conversations seem to keep coming and going, right? People keep bringing it up, saying, I want to do this, and I'm like, I keep saying, but I can't do that. I need to educate myself and take action and either affirmatively say yes or affirmatively say no. Even though I've affirmatively said no, but it doesn't seem to be working. Okay, the bottom line, syndication versus fund. A syndication is pooling funds for one deal. A fund is pooling funds for many deals. GP versus LP, the GP runs things and earns fees and profits, but also takes on all of the liability of a deal. Whereas the LP sits back and invests and earns passively. However, they may lose all of their money if the GPs don't do a good job. Return ranges 8 to 20% depending on the risk, the deal type, and the quality of the operator. Capital stack is risk reward, right? The riskier you are in the capital stack, the higher your potential return. Okay? And we're already qualified to do these types of investments. We're already accredited investors. We're already getting into our first fund.
Which one are we getting into?
The one I talked about. This gonna be weed. I'm just kidding.
And that joint said, what was it, 15,000?
15,000.
Oh, okay.
You'll be fine.
I hear you.
Not financial or legal advice, of course. Always
Of
verify
course.
with your advisors before making investment decisions. And I look forward to sharing part 2 with you.
I'm looking forward to hearing part 2. This was great.
Awesome. Glad you liked it.
Helped clear up a lot of questions that I had. 'Cause when I hear private fund, I guess sometimes get that mixed with just like the private market in general, because you can have a private market, not a fund, like a company who hasn't went public yet.
Yep.
That's not a private fund. But then you have private funds, also companies and things that have not went public.
It's a lot of terminology
Yeah.
and structures.
And they're really close to each other.